Welcome back. In the fall, regulators finalized new rules surrounding the Community Reinvestment Act that's first passed in 1977 to reverse policies that had been depriving lower income and inner city neighborhoods of credit. Originally, the rules were tied to a physical bank branch, encouraging banks in those areas to lend in communities where they were also taking deposits. But in this new iteration, updated for the modern age, it takes into account declining branches in lieu of digital banking and evaluates banks for lending they do on a nationwide basis. Last week, a slew of trade associations, including the American Bankers Association and U.S. Chamber of Commerce, filed a complaint in the Northern District of Texas against the Fed, the FDIC, and the OCC. The plaintiffs say the new rules went too far, and they're seeking to vacate them. The Fed, the FDIC, and the OCC declined to comment on the lawsuit, but others say the modernization is necessary to bring access to credit to underserved communities. Bill Bynum leads a credit union and advocacy group down in the South. He said discriminating lending practices are, quote, still unfortunately rampant, and strong modern rules that account for the ubiquity of mobile banking are needed to close that gap. Bynum said he found the lawsuit, quote, hard to reconcile.
CRA is designed to make sure the banks reinvest in communities where they extract profit. Historically, it was based on where you had a branch. Well, if branches are not no longer the primary way people access the financial system, then you have to modernize CRA. And I think the regulators have done a reasonable job of doing that.
The banking groups say to comply with the final rules in the first 12 months, that cost could exceed $600 million. Tyler.
It's interesting how the change in the way we bank is changing this kind of regulation. I mean, in other words, the branches are closing everywhere.
Yep, they are. And in closing, it kind of created this gap in the system. The CRA, when it was first passed in the 70s, it was directly tied to, and the way that regulators kind of monitored things was based on physical bank branches. So if those branches disappear, that regulatory oversight ensuring there's still access to credit in those areas also disappear. So the intent of these new modernization rules, which, by the way, were updated for the first time in earnest in 25 years, was to kind of fill in that gap and close that gap. But then the banks are saying, you know, this is putting way too much pressure on us because now we have to comply with what is a 650-page amendment to this act. So very long, complicated rules. And we're kind of held responsible for the lending we do on a nationwide basis, as opposed to historically, it was just kind of based on where you had bank branches and they could kind of
But a lot of lenders don't do business
way.
Nationwide. I mean,
a
lot don't. Some do, but, you know.
Or they don't do it nationwide, but they do it over kind of a larger
region,
swath of the
Southeast or Midwest.
Exactly.